Welcome back to the channel. My name is Brad, and today we're going to talk about BALI, and we're going to compare it against JEPI. I chose JEPI because everybody knows JEPI, but if you stay to the end, I'm going to pull up something that you might not know, and we're going to look at what happens when there's a 20% correction. How about what happens when there's a 25% correction? And I'm not talking theoretical. I'm talking about two corrections, 20% and greater. How did these funds actually do? Because if you don't know, JEPI has a cousin. Anyway, BALI is from BlackRock. I'm going to say only the funny business of BlackRock, calling it as it is. So it's on large cap income ETF. Expense ratio 0.35. Currently doing very well compared to the market. Current payouts is about 7.58, but that's also on top of all the price appreciation they had on this year. So you got to throw that in there. Now, one thing that they're looking at is the normal distribution is 1.3. They're paying 7.58. Their returns are slightly less than the market, but they're giving you those distributions and letting you capitalize on those returns also, which is what I like. I like a fund that goes up over time. Just saying. I want my NAV to increase. The volatility of these is lower than S&P 500. That's another plus. Keep in mind, they're selling calls on SPY and SPYX. It's the same as the S&P 500 on where they're writing their calls. So they're writing the 1256 contracts on the index. So BlackRock has $6.4 billion assets under management in income ETFs. Interesting. Just pointing out, not a small player. Now, I didn't go grade these funds. These scored on those 8 and 9 ranges. This fund just doesn't have enough assets under management to get that next tick mark, but they scored very well in a lot of the other categories. One thing that sets BALI apart from a lot of other places is the call options, hypothetically, is a negative because they'll get capped out. But they buy future contracts. Small percentage, but lets that small percentage in future contracts try to offset to give them a total market exposure. Just looking at the current BALI calls, they have a couple that's in the money, but it's a small percentage of the overall portfolio. And then they buy that futures contract. So you're going to see the upside. How did BALI do price return against the S&P 500? They're up 20% in price return over the last year. Now let's talk about JEPI. And we're going to go back to when JEPI was originally created, back right after the pandemic. They're only up 74.03% compared to the market. But notice when the market was down, JEPI outperformed the market. Just like I've tried to explain millions of times, and I still get told I'm wrong, that these funds will outperform in a down market. But what would I know? This is what the data says. Now, if I put BALI, JEPI, and S&P 500 starting on the exact same day as Seeking Alpha, you can see the difference. You can see how close BALI follows the S&P 500 plus pays you that percentage. That is an awesome fund so you can sleep at night. Now, here's some concerns. How does this do when I start pulling off my 8%? Because I want 8% on my investment. That's what I like. I'm going to live on 8%, and anything they pay me in addition to gets reinvested into the fund. If I look at BALI, hey, at the end, my 8% withdrawal, I can do that. You can see if I reinvest 100% back in it's done extremely well. If I take off my 8%, I'm just above my NAV, where I'll be taking everything. It's growing ever so slightly above just investing my $50,000. So this is something that you can sleep easy at night, knowing that, hey, it'll recover, maybe, I don't know. We'll check that out. Will it recover if there's a 20% correction? That's an interesting conversation. Now, let's take a look at JEPI. Does JEPI do any better? How does JEPI do? Oh no, JEPI. So if you go back to when JEPI was originally introduced and you took 8%, well, look at that. Over time, it pays off. So you can be taking 8% out of JEPI and still have more money than what you started with, dating back over 4 years ago. That is something that you should be proud of. Now, if I put JEPI and BALI on the same chart, now what happens, ladies and gentlemen? Does things change? How does it look? Clearly, BALI outperforms. And due to the lack of long-term history, I'm assuming that compounding effect will take effect just like it did with JEPI, and that gap between the green line and the red line will slowly get bigger, just like JEPI did. Now, as promised at the beginning of the video, what happens if there's a 20% market correction, Brad? And let's do 2 market corrections, because we're going to do 2. How about 24%? I look at JEPI, and it's lived through a 24% market correction. And it only went down 11% compared to the market going down 24%. That's a little bit of evidence that these outperform the market in a downturn. Now, Brad, you kind of gave us a little hook there. You talked about its cousin. What cousin are you talking about? So if you didn't know, JEPI, J-E-P-I, has a cousin called JEPIX. It's a mutual fund. Works off the same concept, but it's in a mutual fund. Chart. This chart shows that it started before the pandemic. Uh-oh. So not only did we have a 24% correction in the marketplace, but we also had the correction of the pandemic. So that's 2 large corrections. And how did JEPIX do during those time periods? Well, first, Brad, how big was that correction? It wasn't that big. Small correction. It went down just over 20%. Really quick. During the pandemic. But here it is. If I throw up a graph and I had JEPIX before the pandemic, remember, before the pandemic, and I pulled off my 8% because I want to live on 8% of what I'm making. Imagine that, ladies and gentlemen. I lived through the pandemic. I lived through a 25% correction. And my funds are still worth more than what they were worth when I originally started. That is what I am looking for in funds, where there's corrections, and those corrections, pulling my 8%, we do extremely well. Hopefully this back testing solves a lot of the questions that people keep on asking, because people are saying, these funds will never correct if there's a market correction or a downturn. Well, ladies and gentlemen, the data says you don't know exactly what you're talking about because you didn't backtest. So hopefully this backtesting answers so many of these questions that I keep on getting almost daily. But hey, I'll keep on replying. Now, I want to just point them to this one so they can see what happens when there is 20% corrections in the market. The funds do just fine. They will survive. BALI is a great option if you want large cap from a very large organization. Trust me, they're not going to answer your emails. So hopefully this data answers all the questions I've been receiving about, hey, these funds go up, they go down, they're not going to pay the same amount when they take a correction. Well, the data shows that I can still take my 8%. The data shows they do just fine. The data shows that they will recover. So don't panic. Let the thing called compounding work for you, not against you. Albert Einstein said compounding was the eighth wonder of the world. He was smarter than me. Why do you think that you're smarter than Albert Einstein? I don't get it. So anyway, BALI, not in my portfolio. Could it be? Yes. JEPI, not in my portfolio. Could it be? Yes. The data shows that it could be. But I'm going to stay with the NEOS funds. Until next time, God bless.